Hey everyone, welcome back to Corporate Decoder. In this video, we're diving deep into AlTi Global Incorporated's latest financial report, a document that has got more twists and turns than a pretzel factory. Prepare for a roller coaster of numbers that might just reveal if AlTi is cruising towards success or navigating some choppy financial waters. But before we start deciphering these juicy details, if you love getting the real story behind corporate documents, make sure you hit that subscribe button. And hey, we have a fantastic community of analysts on our Discord server, linked in the description below, where you can connect and share your own insights. Alright, let us kick things off by looking at AlTi Global Incorporated's financial health as of the 30th of September 2025. Their total assets stand at a staggering $1,154 million. That sounds like a lot, but remember, what really matters is how that money is tied up. A significant chunk, $440 million to be exact, is in intangible assets. These are things like brand names and customer relationships acquired in business deals. Goodwill, another intangible asset representing the premium paid over the fair value of net assets acquired in business combinations, also sits at a hefty $385 million. This tells us AlTi has been very active in buying other companies. Now, for the moment of truth, the bottom line for the 3 months ending the 30th of September 2025, AlTi reported a net loss of a whopping $106 million. And for the 9 months of the year so far, the loss is even bigger at $139 million. When we look at the net income or loss attributable to AlTi Global Incorporated specifically, it is also in the red with a loss of $84 million for the last quarter and $106 million for the 9 months. This is a big red flag, folks. When a company is losing this much money consistently, it raises serious questions about its business model and its ability to generate profit. Let's talk about the costs. For the last quarter, compensation and employee benefits alone hit $41 million. Over the 9 months, that adds up to a massive $125 million. This is a huge part of their spending, and it has significantly increased compared to last year. This jump in costs is a major factor in the company's overall losses. Then there is this line item impairment loss on goodwill and intangible assets. For both the 3 and 9 month periods, AlTi reported a massive $35 million loss here. It seems the value of some of the companies they acquired or the intangible assets they bought simply has not lived up to expectations, costing them dearly. This shows that their acquisitions might not be performing as well as they hoped. Looking at their balance sheet as of the 30th of September 2025, there is a dash next to net deferred tax asset and a dash next to liabilities of discontinued operations. This is interesting because as of the 31st of December 2024, they had significant amounts for both. It signals a big shift in how they are carrying their tax assets, and it looks like they have largely exited business operations that were previously considered discontinued. Focusing on continuing operations, the company is still in the negative. For the 3 months ending the 30th of September 2025, they reported a loss of $87 million, and for the 9 months it is a $109 million loss. This indicates that even without considering the discontinued parts of their business, the core operations are not profitable right now. Let's switch gears and look at the money coming in. Their total revenue for the 3 months ending the 30th of September 2025 was $57 million. For the 9 month period, it reached $166 million. This is an increase from last year, which is a positive sign amidst all these losses. Management and advisory fees make up the bulk of this revenue, which is good because those fees tend to be more stable. The number of Class A common shares outstanding has increased to over 102 million by September 2025. This is a significant jump from the 93 million shares outstanding at the end of 2024. This increase likely comes from stock issuances related to acquisitions and compensation. Investors should keep an eye on this, as a large number of outstanding shares can dilute the value of existing shares. The series of preferred stock now stands at over 164,000 shares issued. This is up from 140,000 at the end of 2024. Showing a significant increase, this preferred stock is not only accruing a substantial 9.75% annual dividend, but it also participates in dividends declared on Class A common stock. So, holders of this stock get preferential treatment, which can impact common shareholders' returns. When we look at how fair values are determined, we see that for investments in external strategic managers, the company relies heavily on level 3 inputs. This means they are using inputs that are not directly observable in the market and require a significant degree of judgment. Specifically for these investments, they are using a discounted cash flow approach with a discount rate ranging from 17.5% to 30%. This wide range highlights the uncertainty and the subjective nature of these valuations. Looking at the trends in revenue management and advisory fees increased by $3.6 million for the last quarter compared to the prior year. This growth is attributed to higher assets under management due to strong market performance. However, they did see lower fees from their TIG arbitrage strategy due to fund outflows, which is a bit of a concern. Compensation expense saw a significant jump of $3.3 million for the quarter. Management attributes this to higher costs tied to acquisitions, earn-outs, and streamlining initiatives. While growth is good, rapidly increasing compensation without a proportional increase in profitable revenue is not sustainable. Non-compensation expenses surged by $21.1 million. This increase was largely due to a $4.6 million rise in professional fees and a staggering $16.3 million increase in general administrative costs, mainly due to provisions for bad debt and redress. These unexpected costs are really eating into their profits. And the other income and expenses, for the last quarter it swung from a negative $67 million expense to a negative $28 million expense. Much of this swing is due to significant impairment charges on intangible assets. This means they had to write down the value of some of their acquired assets because they are not as valuable as they initially thought. Now let's talk about earnings per S-Hair. For the last 3 months, the loss per S-Hair from continuing operations is a negative 69 cents. For the 9-month period, it is a hefty negative 97 cents. It is clear that the company is currently losing money on a per S-Hair basis. Turning to cash flow, the company used $53.5 million in operating activities for the 9-month period. This means more cash went out than came in from their core business operations. This outflow is largely due to their net operating loss. In investing activities, they provided $13.2 million of cash for the 9 months. This was mainly due to selling an investment for about $20 million, but this was offset by the acquisition of Contora for nearly $7 million. In the prior year, they used a much larger $85 million in investing activities, mostly for acquisitions like East End Advisors. Financing activities provided $9.5 million for the 9 months. This primarily came from issuing more preferred stock, but in the prior year, financing activities brought in a massive $306 million, which came from issuing equity and then paying down debt. It's a mixed bag here, showing they are raising some capital, but not at the same scale as last year. One of the major ongoing commitments is the Tax Receivable Agreement, or TRA. They carry a liability of $32.5 million related to this. Essentially, they owe roughly 85% of certain tax benefits they realized from the business combination to the original owners. This is a significant ongoing obligation that depends heavily on them generating enough taxable income. Then there is the business combination earn-out liability. This is the money they might have to pay out in the form of shares or cash to sellers of companies they acquired based on future performance. The fair value of this liability is $11.4 million. It is very common for companies that grow through acquisitions to have these earn-out obligations, and it is a major factor that can impact future profitability. So, what is the verdict on AlTi Global Incorporated looking at these numbers? It is clear the company is aggressively pursuing growth through acquisitions. They have significantly increased their revenue and AUM. However, this expansion comes at a steep price. They are currently losing a lot of money, both on paper and in terms of cash flow from operations. Their reliance on level 3 inputs for valuing certain investments points to a high degree of estimation and potential volatility in their reported asset values. The significant increase in compensation and non-compensation expenses, coupled with impairment charges, suggests that integrating acquired businesses and achieving synergies is proving more challenging and costly than anticipated. While the company is taking steps to improve its internal controls, a material weakness remains, meaning we need to be cautious about the accuracy of their financial reporting. The direction is growth, but the profitability is still a long way off. The big question for investors will be if they can turn these top-line growth numbers into sustainable profits before their cash reserves dwindle too much. For now, it looks like a high-risk, high-reward situation, heavily dependent on successful integration and market tailwinds. Alright? That is our breakdown of AlTi Global Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. And as always, don't forget to check out our Discord in the description. It is the place to be for genuine financial insights. Thanks for watching. See you next time.